Hey everybody, welcome to another episode of the Business Barbershop Podcast. I am Chris,
I'm Keen.
and today we're talking about rate cuts or lack thereof. Before we get into the show, that's my monster. Don't worry about that. Don't mind that.
You
Reminder.
just opened up a big can of Guinness.
I wish 2 days, 3 days from that, 3 days away from that. A reminder, if you like the show, if you think someone else might get something from it, then share it. Hit the like button. I mean, you really don't have to hit the like button because we don't care if you like it or not. But leave a comment. Share it is going to be the best way that you can support us. All right. So, Keen, what happened? What's going down in the news today? Something about Jerome Powell and some interest rate not hikes,
Cuts,
reductions or lack thereof.
Lack thereof, yeah. So, it's funny because I've been telling people like for over a month, and it's funny how like the temperature of things change and they almost try to convince you otherwise. But I just knew that like there can only be so much in rate cuts. If you cut too fast, it causes inflation, which is the thing they're trying to fight.
Yep.
So rates being higher is meant to fight inflation. But a lot of economists started trying to project like tons of rate cuts this year. And Jerome Powell came out, I think it was about a week and a half ago, more or less basically saying like, hey, everyone's getting too aggressive with these projected rate cuts. You should expect that you're not going to get a rate cut in March, and you're probably only going to get about 3 this year. I was reading some other kind of predictions, and the Fed typically doesn't want to be in the spotlight right during the heavy time of election. Mm-hmm. So it sounds more like we might get like 3 rate cuts, spread over like a 4 or 5 month period, beginning with around like April. Maybe it goes, and just it's going to be very slow.
Yeah.
But I think that for how that relates to other things, I think that it's still the beginning of rates coming down. But mortgage rates have ticked back up closer to 7 today. But look, they were at 8, and so should they have dropped all the way down to like 6 or 6.5? A month and a half ago, probably not. So if you were lucky enough to buy something and lock something in that rate, great. But it just makes sense. I think it's just slowly worked their way down, and that it keeps costs relatively the same.
Yeah. Is that why the market's down so much today?
Yeah, CPI report came out hotter than expected. Mm-hmm.
I just opened my thing up and I was like, what the hell is going on?
Yeah.
Everything is down. Everything is down almost.
Because everything is beefed up with the idea that inflation is a past tense, and now inflation came in hotter, and that's only going to that CPI report's only going to push the Fed to hold rates where they're at and slowly cut. I do think they will do cuts this year, and Jerome Powell's already said that, expect maybe 3. But if we have hotter than expected CPI reports, 2-3 months in a row, he might cut that down to like only 2 this year.
Yeah.
But what does that mean for the purpose of like I can't tell you exactly how I translate that into your stock investments or your personal living, but I do think when it comes to real estate, people should curb the kind of value gains they think they might get in the next year. But most areas kind of hit their bottom in terms of value already.
Yep.
And I think the cost of housing isn't really going to change much moving forward. It's going to be flat.
Yeah.
But the value itself will slowly climb with very slow rate cuts.
Yeah.
And so, when people ask, what would I do with that information? My answer is, well, if you're on the buy side, right, I would be picky. Mm-hmm. Something that you're going to hold for a long term. And ideally something that has a value add if you can buy something like that. But anyone who's hoping that they're going to use it as a step up to another property in a couple of years without a value add into it, it's probably not good. Yeah. But I mean, I can't say it's worse or better in the future either.
Yep.
I think it's just, everything you buy now should be a relatively longer hold.
Yeah. I think, by the way, I am no financial genius at all. I am merely speculating at best with what I'm about to say. But what it seems like to me is we're kind of right now where we should be most of the time. The problem was there was a couple years there where everything was just real frothy.
Right.
And we haven't forgotten about that yet and failed to remember what life was like before it got frothy.
Yeah.
Because people feel like 6 or 7% interest rates are so high, but they're not that high. I mean, like historically,
That's right around the average.
Right? I mean, so
Yeah.
I think that's also part of the problem. I think
I think we're still going to end up settling with an average rate lower than it was prior to like the 80s.
yeah.
It's helped set a new norm where people treat 6 and 7 like it's high. And so I think that, it used to be that to get sub 6s, we needed a recession. A recession would cause rates to get into the 5s. In the Great Recession in 2008, rates were in the mid 6s.
Yep.
And then it took the Fed jumping in and doing quantitative easing to push it down to 5 and below. And so I do think the new norm will fall in the 5 range, like the 5-6 range, where before the norm was like 7 to 9.
Yeah.
So I do think that's kind of, but I can't say for sure I'm going to be right about that. But when people say, hey, yeah, you're right, there was frothy, we need values to go down to adjust for it. We've already, you have to remember that the Fed actually expects inflation, that there's a normal amount of inflation you're supposed to get, right?
Yep.
And which is typically around 3-4%. Their target to get to 2 is so that way if you get less than expected appreciation of, let's say, 3 or 4, but down to 2, and you hold 2 for a couple of years, that means you're going to get prices back to where they would have been if they never had these 6-7%, 8% inflation that we had for a couple of years, right? You don't need to push down prices as much as you have to keep them from coming up faster than the norm. So that way, if you it's hard to try to visualize this, but if you try to picture like a 2-dimensional graph, we expect 3-4% every year. So if a couple of years they go way higher than that, if we have less than 3-4%, it'll eventually meet the mark down the road.
Correct. It's going to average out eventually.
Yes. If you give it time, reduced inflation will eventually be the cost of goods as if you had normal inflation. If you just, which rates, that's what high rates do. They help kind of curb that growth.
Yep.
And the fact that we've already had a downward adjustment in real estate means that, yes, slow inflation moving forward will help us get to that achieved number. And, they just need to let their foot off the brakes slowly, which is what the high rates are. But they're just nothing but brakes.
I'm loving this news.
Yeah.
To be honest, because I'm house hunting.
Yeah.
Right.
Yeah.
So like it's kind of, I'll tell you this too, by the way. I don't know if you are looking in other markets very often. I doubt you are because you have no need to.
Mm-hmm.
But man, things are so different outside of Seattle.
Oh yeah.
So I got this realtor helping me in Phoenix. I'm kind of looking at stuff, and there, some of these houses have been on the market for like 45, 60, 90 days. I'm like, and I emailed him. I said, this property looks pretty like nice. It's like I don't see anything that wrong with it, right? Why has it been on the market for so long? And he's like, bro, the average here is 75 days. And I'm like, really?
Yeah.
Dang, that's wild. Because you would very rarely ever see that here.
So as a recommendation, when I want to trend values, because real estate's a very regional based thing, there's a section of Zillow, which I don't even know how to get there within their site, but Google can take you straight there. Just type in Zillow local values and then type in the city or the zip code, and you'll see the value graph trends for that specific market.
Interesting.
And it's really valuable to look at that area. And then when you compare it to the other areas you've looked, you can see that trend. You can see, is it going up? Is it going down? Is it flattened out? And so when I tell people, hey, for most areas they've bottomed out, that's just going off like national news and then what I see happening local, but you're 100% right. Like if you talked about like 2008 when we had that Great Recession, right? Everyone just says, okay, yeah, the market bottomed out nationally around January, February of 2012. Okay. But is that where it bottomed out everywhere else? No. Like if you looked at like Detroit, it's crashed and it stayed low for many years past that point.
Yep.
Where Cupertino, California, which is where Apple's based out of, Apple was crushing it in that era. And so they went down about 10% from 2008 to 2009, bombed out in 2010, 2 years before everyone else, and started going up. And they had recovered all of the Great Recession losses, plus were up when the rest of the country was bottoming out.
Right.
And by the time everyone else had come back to pre-Great Recession timeframe, which is, for most of the countries around 2014 to 2015, they were already up double digits above that point. Yeah. And so it's very regionally based, which is why I always tell people, if it's not primarily a tourist town like Las Vegas or whatever, it's mostly the jobs that really drive it.
Yep.
The jobs, the average price point, right? Growth, so forth. And so
I got a question for you.
Yeah.
We changed the subject. I mean, we're still talking about real estate, but we can come back to this too. So there's this, I want your strategic advice.
Okay.
Or thoughts on what to do. So there's this property that I was looking at. It's not really inside of the equation like we talked about last time.
Mm-hmm.
It doesn't need a lot of work. Okay. It's really as far as like what I want, it's pretty sweet because it's kind of eclectic, right?
Okay.
It's not like cookie cutter. It's in they just like redid the backyard, so it's sick.
Okay.
The backyard is fucking sick. It was listed for a price. I don't know I can't remember exactly what the price was. Been sitting for like maybe like this 75, 90 days or so. And we're going to go to Phoenix after, we texted you about this.
Yeah.
We're going to go to Phoenix after we get married next week.
Mm-hmm.
And we were going to go look at it then. But I think today or yesterday, they took it off the market and now it's listed to rent. So like, would you reach out to that person?
Oh yeah,
like,
I've done that shit all the time.
Like, tell me what you would do. Like,
not only would I reach out to them, but you could look at where it was last listed and assume how much they maybe would have taken off, maybe 5-10% off that price, and then I would try to squeeze an extra couple of percentage points off of it. Your agent could still write it up and represent you, but if the listing agent's out of the picture, I would hope for a little bit extra spread.
Yeah.
Yeah.
You would just send it to them.
Yeah, just reach out to them directly.
Yeah.
Mm-hmm. It's not on the market.
Because obviously they want it.
It hasn't rented yet, right?
It's literally just got listed today.
Yeah.
To rent.
Yeah.
Because I somehow because I still had like the listing or the property address.
Mm-hmm.
And so I just searched the property address again. Now it comes up as being listed to rent.
Right. I mean, there's a couple different ways. Your agent can reach out to the old listing agent and try to arrange a showing. But once you introduce them back into it, you might be erasing some of that margin. If you feel comfortable enough to try to reach out to them, like you could just do like reserve, there's those, I have some that you can borrow it with like those services where you can like look up a person's name, get their phone number or whatever,
like
right?
Skip Trace or whatever.
Mm-hmm. Mm-hmm. But the whole like, doing, the whole part where you have to do the whole like making sure that on do not call list, that's different because you're not trying to sell a service. This is literally for your own personal, right? So I would, if there's other properties you're going to look at while you're in Arizona, you could try calling the person. When I try to reach people that I don't know, I find the most effective methods that are free is I try to find them on social media like Facebook and then DM them.
Got it.
Because it's like, hey, you don't know who I am. I just cut them right out of the gate. But I'm trying to get a hold of you for this reason.
Yeah.
And it's very specific.
Yeah.
And I just didn't know any other way to reach out to you other than this.
Yeah.
I've done that before, like where I'm buying properties and there's like a restrictive covenant on title. And then I can't tell if for sure they've abandoned it, but I can see someone else had done work that would have required an approval from the HOA or that neighborhood.
Yep.
And they either did get it or they did it without the approval, which tells me that that restriction's probably been removed. So I'll just tell them like, hey, I'm thinking about buying a house. I might be your neighbor, but I don't want to buy it if I can't do some stuff to it, right? And I saw you did a remodel and want to know if you had to go through that crazy stuff that it says on title. And people are pretty receptive to that kind of thing because it's, they don't know I'm thinking about trying to turn it into a development property, but it falls in the same category.
Yep.
But for your case, you could do the same thing. It's like, hey, I saw your property. I was going to go, there's a small group of properties I wanted to go look at. As long as you haven't actually rented it yet, can I just see it? Maybe we can put them together.
Yeah.
They'll be pretty excited to hear from you probably.
Yeah. Okay.
And they may loop their agent back in, but I would just tell them like, hey, it's your choice if you do so, but it might cause a crimp in the number that we're willing to pay versus whatever. So if you are okay just dealing with my agent too, it might be easier for us to come to an agreement, and then just let them decide.
Yeah.
Yeah.
Yeah, it's a pretty cool house.
Yeah.
Like, it's not a one of one, but it's still pretty cool.
Right. It was high on your list.
Yeah.
For
sure. Yep. And by the way, it has extra space on the back, so you could add like an ADU on if you wanted to.
Even with a pool and all that kind of stuff.
Mm-hmm. Yep. It has like a whole extra lot, not a whole lot, but it has a whole extra area in the back where you could add something. So, yeah, it was cool.
Yeah.
It was cool. All right. Okay, sweet. All right. Let's circle back on these rates.
Yep.
Anything else that
Yeah, I think the biggest thing is like taking what we just said about you looking at Arizona, right? The decision for buying is layered in like your financing costs plus that local market. So timing, if you're going to finance the purchase, timing the blend of the two is important to getting the best deal for yourself. So same thing. At least we know rates are on a decline, although a slow decline, so you don't have to worry about them keep going up. So I would look in area so I would take like where you're looking at Arizona and take that zip code and type it into that local value and look at that value graph. And if it still looks like it's sliding, hey, what's the rush, right? But if it looks like it bottomed out and is slowly working its way up, albeit slowly, then you know your timing is good. You might
What's it called? Zillow property?
Zillow local value, and then type in your zip code afterwards in Google, and it'll take. I don't know how to get to the section of Zillow within their site. Just let Google take you to that section.
I'm just writing it down so I won't forget.
Yep. And once you get there, you can type in zip codes, the cities, the counties, the states, and it'll give you a value graph of homes in that specific area. And then you can, evaluate, at least for the purpose of like value trends, you can see. Because once properties have done an upward or downward adjustment, they tend to not change that trend for a few years.
Yeah.
In Washington, if values bottom out, they don't typically, and they start to work their way upward, they don't trend their way back downward, at least for another 3 to 4 years minimum, usually even longer, unless there's something dramatic that happens. But usually it's something dramatic that makes it short, like 3 to 4 years anyways. Usually it's more like a 5 to 10 year run of going upward before there's any kind of downward adjustment.
Yeah.
And so if you see that things have bottomed out and they're starting to work their way up, you're buying near the bottom of the market, and that's good.
Yep, here it is. This is what I would search for in case you guys are listening. Well, I think what popped up. Zillow market report by zip code.
Kind of, yeah. It just makes sure.
Good?
Well, what's hard is that specific page I'm referencing should be looked at on a desktop, because when you look on your phone, they don't show you the graph. They show you some of the same data, but they don't show you the value graph. And that value graph is, to me, the most essential thing. I'm a data junkie, so I really want to see the trend on that graph, the peak, the valley, what's happened in the last couple months.
Does it look kind of like that?
Yes, except for on this. Yes,
but it has the graph on the desktop.
Yes, when you scroll down, you'll see the graph. When we get done with the show, I can show you what it looks like. We'll look at your specific area and we'll analyze it.
Zillow Home Values Index.
Yes,
is what it's called.
Yeah. That's it.
All right.
That's
cool.
it.
Yeah, there's some cool stuff out there for sure.
Yep. So, what does that really mean? Hey, are rates dropping to make the market better? Yes. Are they going to drop rapidly? No. And I never thought that they were.
Right.
That's why when I've had some people say like, hey, I really want to buy a place and hope to get a couple years of appreciation and trade up, I'm like, I don't know about that. If you buy something that you could turn into a rental down the road, then sure. Because then it's like, if you don't want to live there for more than a couple of years, it serves its purpose beyond that.
Yeah.
But if it's like, you're going to buy something you don't like, but you're hoping to be a stepping stool into the next one, hey, you got like, 7-9% of selling costs.
Right.
Like if you only get 3 to 4% appreciation, you might barely be breaking even after 3 years.
Should you really? Is that ever a good strategy? Like, shouldn't you?
It can be, because what happens is, for a lot of people, they just need some equity to trade up from, right? And I think that, and I don't mind if people are buying now with that strategy, as long as they have a realistic timeline on when the trade up happens.
Right.
If you said, hey, I just need to get my foot in the door, and as long as I have something, and I can always refinance later when rates are low to make it slightly more affordable, then maybe if I buy it, refinance it 1 to 3 years from now, hold it for 5 to 10, and then use that to trade up, for sure it could be a good reason to do it. Especially, you have to picture, like, when I give this advice like a traditional home buyer, you have to remember that many of them aren't in the boat of like the people we're talking to on our show. They, if they're not putting in their 401k, they're fucking spending the money anyways.
Right.
And so it's almost like a forced savings. Tax-free appreciation, of course, your primary residence, right? Some really hardcore investors, like, guy I know, James Daynard, who's a founder and owner of Heaton Daynard Real Estate, and he's one of the Bigger Pockets podcasters. He talks about live and flips. He literally does you would appreciate his homeowner occupied strategy. He buys a fixer, moves into it, fixes it up, lives there for at least 2 years, and then he gets his $500,000 exemption, and then he trades up.
Yeah.
And he just keeps, he doesn't necessarily trade up, he just trades out of it, takes the money tax free, and then does it again and does it again. And he just keeps using that as like a way to kind of take these tax free capital gains growth, because on his income and asset level, there's not a lot of tax shelters. So he's never attached to his primary. He buys something in a good location, needs a fixer, fixes it up, lives in it, gives him his 2-year seasoning, and then he gets to sell it like a flip, but does it 2 years down the road, and then takes all that money tax free and then repeats it. It requires him to, it's a capital gains versus a cash flow house hack.
Right.
But I've always thought that was a good strategy, and he's just one of the few people who actually does it.
Right.
Yeah.
Interesting.
Mm-hmm.
Interesting. Okay.
And for his case, it's like he's not riding that 2-3% appreciation that's going to get. He's buying something that he can force a 15 to 30%.
He's creating appreciation.
That's correct. Any time appreciation he gets on top of that is just icing on the cake.
Right.
Yeah.
Does he move up? Does he?
Not always. Like the last one he moved into was worth less than the one he sold.
Right. It could be a lateral move, but he really is just creating a cash.
Yes.
Essentially. I mean, tax-free cash.
Yep. Buy the next one with minimum down, push up the value, sell it, take the cash.
Use it for whatever you want.
That's
really.
right. Use some for the next one and keep a lot of it for something else.
Yeah.
Yeah. It's actually really smart.
That is really smart.
Mm-hmm.
Okay. Cool. So what do you think? Okay. So right now the strategy, this goes back to what I was saying. I think it's really hard, and we've talked about this. I think you agree for the most part. It's hard to play the interest rate game, and like really, if you're in the mix for a property, you should probably just find something that matches what you're trying to do.
Yes.
And get it.
Yeah.
Because you don't know what's going to happen in the future. You have optionality once you have the property. You can do different things with it based on what actually happens.
It felt like a real novelty to buy house hacks back in the day. In today's world, it's more normal.
Yeah.
It was actually another conversation James and I had. He said that, in a lot of these fix and flips, you get these mid-century split entry homes or basement ramblers, and you get more value ripping out this downstairs kitchen. Well, think about when they were building that stuff. In the 70s and 80s, rates were really high. People were doing the same thing. Right?
Yep.
Let's just find some way to subsidize our costs. So they were like homeowner / landlords. And then when rates dropped, people got lazy and, they would take their luxury with them and make that into just more living space. Right? And so I think that we're just going to see more of that kind of stuff. People should come into the market. If they try to make it pencil just to buy compared to the cost of renting, it doesn't pencil. Even with the tax section, it doesn't. Slow growth, way higher cost of owning versus renting. But if you're going to house hack, right? Like, my friend Kirsten really is dying to get out of her place, and she's a big believer in real estate. So she wanted to buy something, but didn't want to be a renter, right? So I said, okay, look, here's a duplex that when you turn to condos is worth about $200,000 more. Live in one half, do the other, right? And so she has a room for $200,000 forced appreciation. She's going to condo, live in one, remodel it. Down the road, she'll sell that one, move in the other one, do the same thing, right? And with some time appreciation plus that forced appreciation, she'll probably end up keeping one as a rental and then taking the other proceeds from the other one and buy something else and do kind of like a small version of what I said Jimmy was doing, right?
Yeah.
So does it make sense to buy? For her, 100%.
Right.
She bought at the bottom of the market. Her appraisal came in above the purchase price. She bought at the bottom of the market, right? And so locked in it was listed low. It didn't move. She locked it up, got some concessions. It still appraised for $15,000 more. Plus she's got a value add in it. It's like, how do you say no to that?
Right.
But she's got to be willing to do that work too. That's the key. Yeah. Right. And if you're not willing to do that work to get the value add, then.
And she also wasn't waiting for the bottom of the market. She just happened to hit it.
Yes.
Right.
Yes. The value, if she bought the exact same thing for 5% more, 7% more, missed the market, bottom by 5, whatever, that's like $30,000-$40,000 on a $200,000 value add deal. Would it have been better to save $30,000 on it? Sure. But that wouldn't have changed the numbers enough to say wait for it.
Still a good buy.
She just lucked out and kind of striking the iron while it's hot for both.
Yep.
Needed a place, value add. She actually was buying another place. I said, you need to quit trying to. She was like apologizing because she's going to back out of it. I'm like, don't apologize to me. The property's shit. I'm the first one to take it out of it. But, and that's when I found the other one. I'm like, but here's a good one to parlay into. I like this one a lot.
Yeah.
So, yeah.
Be interesting.
Mm-hmm.
Okay.
Just buy smart. Look at your data, analyze your deals closer, and buy smart.
Yeah.
And if you buy smart, hey, it's a great time to buy. But you know what? When you buy really smart, it's always a good time to buy.
Correct.
The market could look like it's at its peak. And in the stock market, it doesn't mean you won't find a company that's undervalued. If the company's undervalued and you think it's a good deal, then buy it. And the same is true when it comes to real estate.
Yeah. I'm curious. This is a totally random question, but I was while we're here. So that the when it comes to the Airbnb data, have you found like awning to be pretty accurate?
It's Yes. So what you have to do is you have to filter your comps. So let's actually talk about Omni because I don't think we've ever talked about it.
I don't
on
know
the
if we
show.
have or not.
So the gold standard for like Airbnb projections is a service called AirDNA, and they charge a lot. Okay. Awning.com is trying to do what Redfin did for regular real estate and trying to say like, hey, if you're trying to buy an income property, we're going to give you rent projections. Like here's all the properties for sale, and here's their rent projections, and here's their AirDNA projections. And so you can type in an address, and it'll tell you your regular rent plus your Airbnb projections. And you know, you have to remember some people do not run their Airbnb year round. So if you see some comps that show really low, you can kind of, and the occupancy is really low, and you can't really tell why it clearly hasn't been rented for a full year.
Also, some people run their stuff like shit.
Yep.
Let's be honest.
Yep.
Not everybody is a business.
Yep. So it gives you like this generic
Right.
annual income, monthly rate or nightly rate, and occupancy rate. But what I'd say is it does a good job of trying to filter out those obvious comps that are not being operated year round. The other thing is that if you're going to operate your short-term rental on a series of platforms, then you can bet that the gross number that you see from Awning.com is a little on the low side because it's only giving you the numbers that they know are getting from Airbnb. So anything from Vrbo or Booking.com or the new Google site that they use for short-term rentals is not being pulled into Awning.com. And so do
you run all those?
I do.
You do all the same time?
And the amount you'll get from other sites varies a lot depending on the location.
Yeah.
So some of mine, it's like putting them on multiple platforms does you almost no good. In some locations, they do better. But Vrbo, I think, typically gets a little more higher end client than Airbnb because they never do like room rentals. It's always an entire place. Yeah. And all of mine have always been an entire place. Even if it's just a small apartment, it's still an entire place. It's not like a room in a place that's being shared. Airbnb lets you do that. And so Vrbo is only like an entire place.
Yeah. Why do you say it's not worth it to put them all on? Like, what's a scenario where it would not be?
Well, I always test all of mine with all platforms, and then I'll find out later on if it made a difference.
Are the prices like significantly different, or are you just looking at like a occupancy rate?
Yeah, it's more like just getting the occupancy. Yeah, I don't change the pricing necessarily from platform to platform. There are softwares that help do that, and so if it wants to do that, it can. But I primarily just want it. More spaces to see it, more exposure.
More platforms.
Yeah, that's correct. Yeah. And, like, for instance, I'll give you an example. I had some in, like, Sumner, Washington, and all of them got booked through Airbnb. Even when we put them on a platform that had more, it was all Airbnb, like 100%. And it was lots of bookings. Mm-hmm. My SeaTac ones, even though Airbnb represented the majority of it, it was as much as like a quarter of all the bookings came from the other platforms. So all the other platforms combined equaled about 20-25%. So to not include those platforms means I know my occupancy is only about 75 to 80% what it could be with the other ones on there, give or take.
Yep.
And so I can expect a higher total occupancy rate having it more platforms.
Yeah. And I sent you one, and you sent it back, and you were like, "That looks pretty good from the numbers." What are you like from a awning number? What are you looking for?
I still break the thing down into the traditional cap rate, even though it takes a lot more management to get the net number. But yeah, it's, I would hope that if there's about a 20-25% expense factor to my Airbnbs on like semi self-managed thing, that I could land close to 10%.
10% cap rate?
Mm-hmm.
Okay.
Which obviously is way higher than traditional rent, but it's also a lot more work.
Yeah.
Right. But yeah, if I take 25% off the gross income and that's close to 10% of your purchase price, then I think it's pretty good. And there's some properties that the thing about Airbnbs is that they create, if you really analyze them, they can create, huge anomalies on income. Sometimes areas that just get absolute shit regular rent for some reason get amazing short-term rent income.
Well, even there's a lot of short-term rentals in Phoenix. A lot.
Yeah.
But you can see
there's also lots of demand.
There's lots of demand. You can see some that just significantly outperform others.
What I would do is when you get your unit going, There's a company and a guy that really focused on having killer Airbnbs. They're all in locations that are strong Airbnb markets. Typically, all areas that also have lots of competition. The homes are called Loma Homes, Loma Homes.
Okay.
He is the founder of a software program called IntelliHost, which helps. They created a platform for themselves to kind of analyze what they need to do to optimize their listings to get the most income. And they try to make price the last factor, right? Is it not advertised well enough to get people to click on it? If they click on it, are they not just coming through to actually booking it? And if you hit any of these kind of like hurdles and the software recognizes it, it can give recommendations. So that's IntelliHost. Anyways, they created that for their own listings. But I think if you want to have a unique Airbnb in a market that you have lots of competition, looking at Loma Homes is a really good example. For instance, they have some homes in Orlando near like Disney World, right? And if you look at them, they make their houses look like castles and spaceships.
Right.
Some really cool shit. I mean, it doesn't really fit my platform for making the property easy to sell necessarily.
Right.
But for just revenue basis, it's brilliant, right? I mean, their places totally stand out. But they also have some places that have some really cool just general design. And I think that, making your place stand out is key. I mean, look, it's the same conversation I have when it comes to real estate agents who are trying to like figure out how to get the business. You get too focused on like what the average person gets and say, if I can get any piece of that, I'm happy with it. But I think every business owner should come into a space saying, like, if we're all competing, what am I doing different? Like if you and I were going to say, let's open a 5-star steakhouse in downtown Bellevue, well, fuck, there's like, which ones are already getting killed? Roost Chris is kind of getting killed, right? El Gaucho is like, even though they're a local established place and they're doing okay, they have STK, they have, what's that new one that's in Lincoln Square too? They have a Daniel's Boiler.
Even John Howie.
John Howie, 100%. And there's that, what's that one that?
I can't remember.
The steak and sushi place. I can't remember what it's called. Anyways, new place, expensive, whatever.
Yep.
The point is that there's a lot of competition. If we were going to open a 5-star, luxurious steakhouse, steak and seafood place in downtown Bellevue, we should all be excellent customers and critics of the competition and determining what and how are we going to differentiate ourselves to everyone else. I think every business owner should not come into a space saying, oh, there's so much opportunity because there's all this demand for this space. Like I think all the people trying to get in like the cannabis business about 8-10 years ago, whatever. Great. What are you going to do different? Whether it's going to be location and marketing and product design and customer service. And you can't just assume because there's all this demand that you're going to crush it, because at one point competition will catch up to you and you need to stand out. So unless you want to do all this hard work to start a business just to have it kind of trail behind the rest of the competition as it gets flooded with competition, you have to be thinking about how to always be better. That's where, I think that, I think the Japanese really get a good hang of that stuff when they think about like these philosophies, this kind of Kaizen philosophy when it comes to business is always improving. How are we going to always improve, right?
For sure.
But, every single time I think about starting a short-term rental in a specific market, the first thing I do is say, how can we be better? Like I look at the listings. And then after you get one going, you kind of evaluate it. Like my SeaTac ones, it was like one of the nicest ones on Angle Lake. And what I learned is that you can get a premium, but the premium gets kind of capped. So for the next couple, we just didn't make them as nice, and we're okay getting a less revenue, and our remodel was less, and it works. But also the first time we got one up and going in Alki, it was a small space, but we really decked out the place, and it did really well, even though it was against a lot of competition. So it tells me, hey, it's probably okay to keep the quality of the units a little bit higher, right? And so every market you go into is going to have a different response. You just have to be able to pay attention to it. Yeah.
I'm excited to get something. Hopefully I can find something that works.
But if you're going to a place where large houses are common and there's lots of competition, right? Professional photos, really good design, and some kind of pop to make the place look different. And that's why you don't have to copy what the guys are doing at Loma Homes, but it really should be an inspiration to try to make your place look different. And that's where I also say like, hey, it's kind of cool that this is a space where you can kind of have fun with it.
Right. I also think too, like I've rented Airbnbs for, like when I do my little quarterly meetings and stuff like that, and taking a little bit of time and making them fun, Yeah. People are going on vacation most of the time. Like give it some character. It doesn't have to be a castle, but even just having like, I don't know, good design, like you said, funky art, not even.
That's why we're excited to get one going in Lincoln Park on the property we have, but we're going to have to make sure we warn the guests like, hey, it's a steep set of staircases to get to this cabin. But when you get there, it will be as unique of an Airbnb experience as you're going to get, because you're on like this little cabin off a hillside with unobstructed views of the sound, walking distance to the beach. Just be careful if you're thinking about booking a place with a bunch of heavy luggage. There's no bellhop.
Right.
And some steep stairs.
Right.
And if you go tumbling down that staircase,
It's on you.
it's on you. That's 100% right. But how's that any different than what, like, think about some of the best Airbnbs are these people who did like these fancy tree houses,
Yep.
right? You don't think the guests for those ones know? You're climbing up some weird ladder staircase, spiral staircase to get to your unit. Same kind of deal, right?
Yeah.
And sometimes those ones, even if they have those kind of features, they do the absolute best.
Yep.
Because they just create, it's a different experience for guests.
Totally.
Mm-hmm.
I'm excited about it.
Yeah.
Okay. What else? You got anything else?
I think
We're
that's
wrapping
it.
up. All
Yeah.
right. We had to do a quick
Slow
one.
growth, guys.
Kids getting yelled at. I was late.
Yeah. But just remember, we're probably past the peak of rates, but don't expect them to come crashing down. It'll just
Right.
be steady as she goes,
Yeah.
right? Just think about like, hey, if you're coming off an off ramp and there's a stop sign up front, you don't slam on the brakes and you don't go their full speed and slam on the brakes. You're just slowly working your way there, and that's what the Fed's doing when it comes to interest rates. Yeah, they
Yep. It's also, I think, just as we parked, important to remember, like, it's okay to hit singles. It's okay to hit doubles.
Mm-hmm.
Not everything needs to be a home run.
And if you want it to be a home run, it's probably something you have to create the home run value in it. It's not something that it's going to just be apparent from the outside.
Well, right. If it's going to be a home run, you got to be very, very specific about what you're looking for.
Yep.
And how you can make it a home run.
Yep.
You're not just going to find something that you can just, I don't know, somebody didn't notice something.
Some
right?
person's garbage is someone else's treasure or something like that, right?
Yeah, but even with that for you, that's exactly what I'm talking about. What a home run looks like because you know what you are looking for specifically.
Yep. My buy box,
That-
as unique as it might be,
Right.
might be a 10 out of 10, and someone else's could be like, my stuff tends to look kind of weird to a lot of people.
Yep.
No question.
Well, even sometimes it doesn't look weird. They just don't even know. They don't. They don't even. They couldn't even comprehend buying something, putting 2 ADUs on it. Like they wouldn't even know. Oh, this is a big lot. Like there are these other opportunities.
100%. And really, that is what it means to be a developer. Having vision, and your vision is accurate to what the code says you can do.
Right.
And your vision is also accurate to highest best use, which is going to be the maximum price value profit you're going to get out of it. So, all you're doing is being a developer, seeing things other people can't see, right?
Yep.
Yeah.
Love it. All right, cool. Let's wrap it up. As always, if you guys like this, share it. Leave us a comment if you have questions or want us to talk about something, and I don't know, let us know somehow. Otherwise, I am Chris.
I'm Keen.
This is the Business Barbershop Podcast. See ya.
See you guys.